or money to a corporation. Second, this is a financial security, and that implies that it is standardized. For example, there are 1,000 identical bonds that there are in low denominations. Typically, a bond is €1,000 or $1,000. So Siemens borrows €100,000 by issuing 1,000 let's make that 1,000,000. And Siemens borrows €1,000,000 by issuing €1,000 bonds and 1,000 of them. That also makes them liquid, and this liquidity means that you can sell them fast and at a fair price. You don't have to discount them because there isn't a market for trading them. Going back to the lectures here, it says that bonds are standardized, they are traded debt, they are securities that are issued at small denominations, and they are covered by a general contract that is called bond indenture. This word indenture is important because most of us think that if a corporation borrows and doesn't pay interest, they are in default, and therefore the remedy is bankruptcy court. But default happens also if they violate any one of their promises that goes in this contract or bond indentures. So, for example, 1,000 identical units of $1,000 face value bonds are issued by, let's say, IBM, borrower, through an investment bank. This investment bank serves a function of issuing the bonds and essentially giving the market assurance that this company is not a fly-by-night company. It's a trustworthy company, so you and I can loan money to them. And this is part of financial democracy in a free market, meaning that with saving $1,000 or euros, we can act like that multimillionaire that loans money to Siemens. As I said, this bond indentures go into an instrument that we also call it trust deed. That's an identical word for it. And it has negative and affirmative or positive covenants. That word covenant is a little weird for us too. It comes from religion, covenants with the Lord. We are promising to do things and not to do things. So negative covenants are promises that the company does in order not to do things. Typical negative covenants are on items such as assets. The company promises not to sell the factory in Hebron as long as they have these bonds issued in the marketplace. Again, the idea is to make these bonds safer and to make sure that we don't have a fly-by-night operation, a company that borrows from us and disappears. Well, if their factory is here, it gives us more safety that they haven't disappeared. We see the factory humming. There could be actual collateral. The word collateral means that an asset is tied to this bond and it cannot be sold. And in case of bankruptcy, this bond has first claim on this asset. We are used to this word collateral when we borrow for buying a car. In that case, the car is often collateral for the loan, and sometimes the issuer of the loan, the bank, may actually have the title to the collateral. They own our car, we don't own it. And that makes it much easier for the bank to come and take our car away if we don't make payments toward the loan. There are also restrictions that are negative covenants about additional borrowing, because additional borrowing would make this issuer of the bond less safe. Those restrictions could be on senior debt. Senior means this debt has basically stays in line first in bankruptcy, gets paid first. And junior debt has second claim, is second in the line. So if there is a restriction on senior debt, it says you can't issue more senior debt with the same sort of seniority as this particular bond. Because if the company issues more senior debt, it makes this bond more risky. And of course, junior debt bonds would be paying more interest because they are more risky. And we may also have restrictions on even issuing more junior debt. So that would also be a negative covenant. Other typical negative covenants are bonds that talk about the firm not being able to issue dividends to stockholders or owners before it makes payments on interest. And again, that makes sense because we don't want a company that is close to bankruptcy paying all the money to the owners as dividends and again being fly by night running away. So bondholders do all kinds of things to make this debt contract safer. Debt contract is safer than ownership of a company, no matter if even this debt contract is a junk bond. Junk bond means it has a high bankruptcy risk beyond the investment level. But the stock of that particular company would be even riskier than its bonds. Then there are affirmative covenants. These are promises that the company makes to do rather than not to do. For example, a very typical one is the company promises to maintain a particular ratio of debt and equity. For example, maintain a 50% ratio of debt and equity or more. That means they can't issue so much borrowing that more than half of their capital structure is borrowing. They have to have half of it as owner's money or more. Other affirmative covenants are to maintain working capital, because if the company does not maintain that working capital, which is short-term capital, they can't operate short-term. So that's, again, a warning sign of bankruptcy, and bondholders want to remove this risk. Finally is net worth. We may have some affirmative covenant on the net worth of the company. This could be measured by the bottom of the balance sheet, or it could be measured by the stock price multiplied by number of stocks. And that would be market value, or if it's balance sheet, it would be book value. But in either of these cases, we are worried again about the company becoming an empty shell with no value and running away with the money that the company borrows from bondholders. So there are all kinds of issues that get investment bankers involved and also get the financial authority of a country involved to regulate this bond market and protect the investors against fly-by-night operations. And you get all this essentially important legal definition of terms, which happen to come in the CFA questions. Additional terms that we should be aware of in the CFA exam is this par value. The word comes from golfing. If you golf and the par is 4 and you make it in 4 shots, it's acceptable. If you make it in 5 shots, you're under par. You didn't do too well. Par value also means face. That one is easier to understand. Think of face of the bond. This is a piece of paper, and on face of it, it usually says 1,000 euros. So face value is how much this bond is worth on the face of it. But this face value is also called par value. You could also call it the principal, the amount that you loan Siemens. You give them 1,000 euros, the principal is 1,000. The confusing fact is that this face value is not equal to the bond price. You pay Siemens 1,000 as a loan, but you look at the newspaper and you see the price of this bond had gone to 1,200. How come? Well, this happens when the bond pays more interest than it should, more interest than it is justified by its riskiness. In fact, many bonds are started that way to make it more sweet. We look at something that is priced as 1,200, worth 1,200, and we feel that this is a safe bond. So that's somewhat psychological. But as this bond trades, something may happen to the creditworthiness of the company. For example, ThyssenKrupp was downgraded. Their credit was downgraded to single A from double A. When that happens, the old bondholders that paid 1,000 now have their bonds devalued. The price goes down. A new bondholder wanting to purchase the bond from you doesn't want to give you 1,000. Will go and pay 1,000 and get a bond that is rated higher. Now the company is rated lower, their bond price goes down. This is the kind of thing that happened when the bonds of the government of Italy was downgraded. And the bondholders would have less value for that bond. This also tells us something about riskiness of bonds. It is not that when you loan money by giving a bond that you do not have risk. Just like the stocks, the price of this bond changes every day in the marketplace. And if the company or the government, the borrower, gets more risky, your bonds become less valuable. We also have this definition of premium bond. It's a very easy definition. If the face value is more than 1,000, more means premium. We say this is a premium bond. If the face value is less than 1,000, we say it's a discount bond. Less means it's discounted. And if the face value of the bond is 1,000, you simply say this is a bond. You would also know this by two interest rates that are associated with the bond, and that would also make it confusing for us. One is called coupon rate. The coupon rate is written in the bond contract. For example, the bond says that they are paying 10% interest. That's the coupon rate. But the company would make you a different amount of money, and that's called yield to maturity. Yield is the interest or return that you get on your investment. For example, the bond is priced at 1,200 and pays 10% interest. Well, when you put 1,200 and buy the bond, you don't get 10% on 1,200. You get 10% on 1,000. So the coupon is always paid on the face value of the bond. And because you get 10% on 1,000, it's less yield. You make less money on 1,200 initial investment that was more. So with premium bonds, we have a yield to maturity that is essentially less than this coupon that is given on the bond. And the coupons can be paid once a year. That's quite customary, and we call that an annual bond. And it could be paid twice a year, and we call that the semi-annual bond. So if the bond pays 10%, again, it's 100 euros, 10% of 1,000. Bond price is almost always 1,000. And this 100, if it's semi-annual, they pay you 50 euros interest every 6 months. Let's go over lecture notes and see if there are more terms that we should cover. The word coupon is, of course, an old name, and it comes from the time that the bond was a piece of paper and it had these coupons attached to them, the things that you use a scissor and cut from the piece of paper and you mail to the company and they give you interest. We still have bonds that are bearer bonds, and they are in the lecture notes. The thing about bearer bonds is that they don't have to have your name. So it gives a certain amount of privacy to the bond owner. Of course, the government, for tax purposes, can always get your name, But again, if you're a public figure and you don't want your name to be in the records of the company that you are such a rich bond owner, you could have a bearer bond. In the case of bearer bond, we still get a piece of paper and we have to send them their certificate to get the money that we borrowed from them. And these coupons are also papers, documents that we have to send, and every time they send us the interest. But most bonds are not that way anymore. Most bonds are registered bonds. You register yourself with your account number and you pay them €1,000, for example, if it's a par bond, and then the company starts putting interest in that account, let's say semi-annually every 6 months. And then after 10 years, if the maturity is 10 years, the company pays the principal or the €1,000 back to you. That also says that if the price of the bond becomes discounted, eventually it goes back to par, because at maturity, if the company doesn't go bankrupt, it pays you 1,000. So if the bond is worth 900 now, and the company does not go bankrupt, you eventually make 1,000. A good example is Greek government bonds. When Greece had a crisis in the bond market, they went half price. If you bought them for €500, they went half price because there was the risk of bankruptcy and it was substantial at that time. If you bought them for 500, at the end, waited 10 years, you still get 1,000. And so people who buy them so cheap, of course, shoulder a lot of risk, because bankruptcy risk is a lot more than German government bonds. But at the end, they make a lot of reward, and their price will go from 500 to 1,000. Maturity is something that doesn't need a definition for you guys. Basically, for how long you loan your money on this bond. A 10-year bond would have 10-year maturity. Yield to maturity is important. It's called YTM, and this is really the return you make on your money. Often we calculate it with that financial calculator, and I have examples in the lecture. And some of these examples go back to high school. They're quite simple. So if a bond, which is 1,000, pays you 10% interest, you say, okay, 1,000 goes out of my pocket. That's minus 1,000 in an Excel sheet. And then you have €50 every year coming down for 20 periods for a semi-annual bond. And then you do an EKV in German or IRR in Excel in English, and you calculate the internal rate of return, and that would be yield to maturity. And on your financial calculator also, you have buttons to input this, and I'll refer you to the manual of that financial calculator for that kind of calculation. And I have examples later on. Of course, the currency of the bond is important. If we loan to IBM, it might be in dollars. If you loan to Siemens, it might be in euros. And when it's foreign currency to us, we also have transaction risk. We have the risk that the value of their currency might crash or go higher or lower in the future. It fluctuates against our currency. And that way we make more or less money, and that's an additional risk. The word redemption, again, goes to religion. Basically, it says that you get your money back. The bonds are redeemed. Sometimes the bonds are redeemed in the middle because the company has a call option. The call options are usually reduce the value or the price of this bond, because essentially people pay their debt when interest rates become lower. It is beneficial to go and borrow at a lower rate and retire this higher rate debt. That's why sometimes banks don't give us that option when we borrow for a car loan or we borrow for a house loan. You may not have the right to prepay this loan before it matures. That right is called essentially a call option. You're calling the loan. And when you ask for this call option, or in some legal jurisdictions such as the USA, for some bonds such as mortgage bonds and also for mortgage borrowing, and the call option may be legally mandatory, like the banks let Americans prepay their loan and move to a different house, because it's very common for them to sell their house, let's say, in 3 years or so. But when that happens, the interest on a loan that has this call option is higher. So there is no free lunch, you pay for what you get. Convertible bond. Basically, you can make these bonds into stocks. They are common for companies that are in their growth stage, but they are substantially risky. So an investment banker or other investors may be happier with bonds that pay interest regularly. So bankruptcy shows its ugly head sooner. But as you know, debt does not participate in the growth of the company. If you loaned money to Microsoft when it was a small firm and it was a 5% interest, you only made 5%. But if you had their stock and participated in their growth all these years, you might be a millionaire. So these bondholders would like to convert to stocks if the company is successful. Of course, as I said, there is no free lunch. If you make the bond convertible, you're basically giving an option to get stocks, and this option will make the price of the bond cheaper because you're giving the buyer something extra, this potential to participate in the growth of the firm. Warrants are similar, and they give you the option to purchase a stock, but they are separate from the bond. So you invest, let's say, 1,000 euros, and you purchase a bond of Siemens, and they give you two warrants that are options to purchase more stocks of Siemens at a certain exercise price, for example, 100 euros. And these warrants, like any option, become valuable when the stock price goes much higher. So this is another way to allow you to participate in the growth of the company. And of course, you still have to pay this exercise price, for example, 100. But when the stock price is 150, you pay 100 and you become a stockholder, and the stock is worth 150. And this option has a value which we can calculate with Black-Scholes formula, and that value is something we have to pay for. Therefore, the bond price becomes more expensive when we get some warrants for them. And of course, companies, issuers do this because the debt is becoming too costly for them, and they want to get some discount, and they get it by giving you some potential to participate in the growth of the company. So these are separate securities that are bundled together with bonds. Options are usually short-term, but warrants are not. So warrants could be options that have lives of 2 years, 3 years. So in that case, we call them long-term bonds, long-term warrants, long-term options. Putable bonds. Essentially, this gives you the right to throw the bond at the company and say, give my money back. It's a put option. Again, if they give it to you, it would increase the price of the bond. It makes it more valuable, and therefore the company pays less interest to you. Put options protect you against the price dropping too much. So if you put your retirement money into bonds of a company and that's putable, and let's say you purchase these bonds at 100 and they are putable at 50, 50 is a floor on how much money you can make, and your bond prices cannot drop under this. And then the company is facing bankruptcy. Once the price gets close or under 50, you can hand in the bonds and demand your 50. Income bonds. These are not popular at all. There aren't too many of them, but theoretically it's possible to issue. And essentially an income bond says that if company has the income, they would pay the interest. And if they don't have the income, they can avoid and skip the interest. And because of that, they have a bad smell of bankruptcy about them. If we think theoretically, these income bonds are no different from stocks, because the stocks also say the company pays you dividends if they have the profit, and they don't have to pay dividends. But this is not what we expect from loaning money. When we loan money as a bond holder, we are not really participating in the growth of the firm. We are not really owners. So we want this relatively safe cash flow that is constant, and we don't want the company to skip it if they don't have income. Of course, income bonds have this interest accumulating, and they pay it at the end. If a company does not want to pay interest for one or other reason, there is a different instrument that is popular in financial markets, and that is called zero coupon bonds. Zero coupon means the interest is zero. But don't be confused by that word. It doesn't mean that you don't make any money. It just means that you give them 900, and at maturity they give you 1,000, and that extra 100 is the interest. But they don't pay it every 6 months. It accumulates, and all of it is paid at the end. So we just want to make sure that they are safe enough to pay the interest at the end. Most American treasury notes, treasury bonds, loans to U.S. government are discount bonds and zero coupon bonds, essentially meaning that you don't get anything in the middle, you get all your interest at the end, and that's fine if that's how the contract is written originally, and we believe that they are safe. Then we have index bonds. These bonds pay you more if the inflation goes higher. Obviously, they are for inflationary places where inflation is quite significant. Fortunately, in Germany, we haven't had that problem for many years, but recently we got some inflation. Index bonds are not very popular in this jurisdiction, but Americans and some high inflation jurisdictions have. They make you whole with inflation, and in that sense, they keep your consumption constant. Therefore, you don't have to worry about inflation if you put your savings in an index bond. More bond terminology. As we go on, the terminology gets a bit more obscure and a bit less likely to appear in the exams, but I do a few more and then leave the more obscure ones for the end of the lecture. PIK, or pay in kind. Essentially, it says the bond gives you more bonds instead of interest. And this is interesting if we want to increase our investment in the company, and it's a way of saving. But for tax purposes, it does not save you on taxes, because in most jurisdictions, whether the company pays you additional bonds or stocks, if you earn interest, you have to calculate, or even if you have a zero coupon bond for 10 years, for 10 years you don't get any interest. But the tax authority wants you to figure out how much money you make over the 10 years from this bond, divided by 10, and every year pay taxes on it. So basically, taxes on bond income are paid yearly by investors. And as we discussed before, the beauty of the stocks are that we pay no taxes on them until we sell them. So if we have the share of, I don't know, let's say Apple for 20 years and we make millions on them, all that millions would be tax-free until we sell the shares, and then government calculates from the basis that we bought the shares to millions that we made at the time of sale, and then we have to pay taxes on this capital gain. So when it's paid in kind, you have a choice. Either you get cash or more bonds, and that way the saving is you don't have to go through an investment banker or your bank and pay some transaction cost. The company directly gives you some bonds. And there are deals like that with the stocks too, where the company, instead of paying dividends to you, directly pays you some dividends. And those are usually good deals. And they, if you invest for personal finance, those are good deals, and this pay-in-kind bonds also saves us some money if you're not normally investing in that bond. Poison put, as the name tells you, this thing is quite negative. This is really a defense against takeover. So when the bond is issued, the company puts a requirement on the bond that says that if the company is taken over, all of this debt had to be paid off immediately. And the reason they do it is they're very much worried about takeover, and this would make them a poisonous thing to eat, because if another large entity comes and buys their stocks and wants to force the management to go out and bring a new management, they have to immediately pay all the debt, and this could be quite a bit of money, and the company may not have resources to do this, and the entity that is doing takeover may not go after this takeover. Poison put. We call it a put because this is the right to give the bonds back. When there are purchases of bonds with puts, there are various ways of doing it. One method is to go to open market and the company buys its own bonds in the open market. Usually they do that when their bonds are discounted. And there's an obvious reason for that. The bond is worth 1,000 euros, but now the price has dropped to 800. So the company pays 800, buys bonds and retire them. And then the company does not have to pay 1,000 to debt holders. The other method for getting rid of bonds, when, for example, the company can call its own bonds, is to purchase them by giving the people the 1,000 euro that the bond promises, let's say after 10 years, giving them to them right now and getting the bond. And of course, the company does this when our bond is worth 1,200. They give us 1,000 and get rid of more expensive premium bond. But as I said before, there are no free lunches. All of us investors know this. And so when we get into the contract and purchase a bond, we want to know if this bond is callable. Callable means the company can pay us and get rid of us as someone who loaned money to the company. If the bond is callable, it becomes cheaper. We pay them less money for it. Cheaper means at the beginning, we don't pay them 1,000, we pay them 900, and they pay interest on 1,000. So they give us more interest, they give us more money, but we pay a cheaper price to buy it. Now a company makes this bond callable. We are again worried that the bond goes to 1,200 and they come and want to buy it at 1,000. So there is also a call premium that is written in the contract very early on. The call premium says that if you call the bonds, you have to pay, for example, 200 euros extra. So you can't buy these bonds at 1,000. You can only buy them at 1,200. There is another safeguard that people get. We don't want to invest 1,000 in a bond and loan it for 10 years. And then after a month, the company is saying, oh, I want to give you your money back. Go invest it somewhere else. Because we had transaction costs, we had to pay a broker. We want to invest for 10 years. So to prevent that, usually the call also has a time. It says the company cannot give our money back and call their bonds, for example, for the first 2 years. So there are restrictions on this call. Wait 2 years, pay 200 euros extra, but then you can buy these bonds, and then you have two methods: buy them discounted at the open market, or pay people par value, but you do that when their bond is worth more. Zero coupon bond, I talked about them before. Basically, it means that interest is zero, but it doesn't mean that you make no money. We also call them discount bonds because today we pay 800 discounted price, not 1,000, and a year later they give us 1,000. So the price is discounted and the interest is in that discount. Step-up notes, these are very unusual. Essentially, their interest increases over the years. This is for a company that is in earlier stages of growth, doesn't have a lot of money right now, and says that they are going to give you more interest later on when their products become more mature in the marketplace. Sometimes borrowers do this too. We might be early on our career and our income is not as much, and we are hoping for some promotions. So we borrow a little bit more, but later on it becomes comfortable when the promotions come. Deferred coupon, again, the company delays some payments of interest, for example, for the first 2 years of the bond. For that period, the bond becomes a discount bond, but it doesn't mean that you don't get the interest. And also, all of these are sweeter because if we know them from the beginning, we know that this is not a financial difficulty that hit the company, and therefore they can't pay us. From the beginning, they are coming to the table and say, for 2 years, I don't want to pay interest, but after that, I pay it because I have a growing marketplace that I need to invest a lot in. Floating rate securities. And the floating rate bonds are very unusual. Usually bonds have a fixed coupon, but unusual doesn't mean that they don't exist. Floating rate debt is more usual, particularly in American market for people who borrow for a house or a car. And that is not as common in German market either. We usually get a fixed loan. Floating rate basically means that the interest rate on your loan changes over time. Usually these floating rate interests are lower, and they are defined by some benchmark. The best benchmark is cost of funds. The bank says this is based on how much the funds, the money costs them, because they have to raise this money that they loan you from, let's say, borrowing from the central bank or other banks. And then they put a percentage profit or default risk on it. For example, cost of funds plus 1.5%. Old times, it was very common to have LIBOR plus 1.5%. LIBOR as a benchmark doesn't exist anymore. We have two alternatives. One is the SARON, which is cost of funds in Switzerland. It also says that LIBOR was London interbank market. London is less important these years. There was a scandal about LIBOR, and then it was discontinued. So the funds may come from Switzerland based on risk-free cost of debt there, and then you add something from it. Or it could be cost of funds in US. Those are the two important benchmarks these days. And again, those are risk-free cost of funds loaning to US government overnight or so forth. Then we talk about foreign bonds. Of course, this depends on the country we are. But foreign bonds are bonds that are issued by other countries. And there are three important regions financially to raise capital and issue bonds. Of course, one is Europe, the other one is US, and the other one is Japan. A Yankee bond is a foreign bond in US. So if a German company issues bonds in US, which is possible, they call it a Yankee bond, and usually this is investments that American investors would invest by buying bonds of Siemens, for example. It's sold publicly. A samurai bond, as the Japanese name of this warrior indicates, it's a bond, a foreign bond that is issued in Japan. So again, Siemens can issue bonds in Japan, and they may be in yen, and investors would be Japanese, and we call them a samurai bond. And then there is the famous euro bond for us. If someone issues bonds in euro, we call them Eurobond. Usually we mean foreign concerns. But of course, domestics also issue Eurobonds. Bond registration, this is something I talked about before. Either we register in our name. So you say, I, Jane Smith, I'm giving you 1,000 euros, and the company registers you and bank account, and interest goes to your account, and the tax authority is basically informed about you, and you are the bondholder, and at the end, after 10 years, for example, they send your 1,000 euro back to you. Or there is this bearer bond, and as I said, this is private, and they don't register the bond in your name. They give you a certificate, and this certificate is almost like money, because if you lose it, it's gone. But the nice thing is you could give the certificate, let's say, to your kids or something, and that may avoid taxation. And may is a big deal here because government still may want to know who owns these things. So a lot of it is for privacy. And of course, the interest is paid by the owners sending this coupon or piece of paper they have, or going in person to the company and cashing it. And as we go on, the words become a little bit more obscure. Defeasance is a method of retiring corporate bonds, and this really means that you involve a trust, a legal sort of setup involving attorneys, and usually companies, particularly in the US, are required to put treasury bonds there. These are risk-free government bonds, basically acting as money, and the trustee or the trust company uses that money to purchase bonds and retire them, and this also prevents essentially discriminating against owners. Sometimes the owners are chosen by randomly, by some random methodology. But if our bonds can be called, purchased, and let's say your bond is worth 1,200, you don't want to be the one that the company picks at. If you come from a random drawing and then they give you 1,000 instead of 1,200, it comes from this trust fund, and the trust fund in the middle is to ensure that there is no privilege given to some insiders that the company knows and doesn't retire their bonds. Debenture basically means debt, and the word debenture is used if debt is not secured by some asset that back it, so it does not have collateral. Most bonds are debentures. Most bonds essentially are guaranteed by all the assets of the firm in general, not a particular asset. As I said, mortgage bonds, or maybe I didn't say it, mortgage bonds are debt that have real estate backing them. And it's pretty well known because you know it from the houses that people buy. You buy a house and you borrow 200,000 euros, and the house is essentially backing this loan. The company can go after the house as an asset if there is bankruptcy. Um, if real estate is backing a loan, which could also happen with bonds. For example, the company says, my factory and the land around it are backing these bonds, and that makes the bonds sweeter, the bankruptcy risk is smaller, and the price of these bonds would be cheaper. The company has to pay us less interest. That would make it mortgage bonds. Then we have ABS, which is very fashionable these days to talk about. These are asset-backed securities, but these assets generate some income, and we carve this income and define them differently. Let me make a very elementary example of ABS. Let's say your firm is a real estate firm and has 1,000 houses that you rent, and some of these houses would have cost of maintenance. The heater may break, so you have a bunch of costs, and then you divide this asset into two parts. One part is actually the real estate, the value of the houses. The other part is the rental income, and you sell this to two different entities. ABS had become very common these days for generating cash flows at different risk, and some of these ABSs have backfired. But essentially, you sell cash flows for someone who wants regular rental income, and then someone who wants appreciation of the building prices as capital gain. You sell them the buildings. Sometimes these ABSs are done to do financial shenanigans, and by that I mean to take advantage of investors. A very famous case that ended up in court was this Marriott American hotel business. They cut their business into two parts. One part had the management of the hotels, and that part was making management fees and was very lucrative, and they kept that part mostly to themselves. And then they cut off the buildings of these hotels. Again, by this cutting off, I mean financially on paper, and gave the buildings, together with heavy debt that this sort of real estate usually has, to different owners. And this way, they extracted a lot of value from this second set of the owners, and the owners went to court and said, this is not fair, they're robbing us, they're taking our assets, and the court decided for them. So the infamous case of ABSs. Sometimes they are done for illegitimate reasons. Then we have accrued interest. This sounds difficult, but it's a very easy concept. You basically have a bond, and it pays interest, and it pays interest in March every year. And you sell that bond to me in April. Well, you have earned 1 month of interest. This accrued interest means that I got to give you a month of interest. And of course, there is a formula for it, and the formula is very easy. It says accrued interest is days since last coupon divided by days between the coupons. So in my example, this becomes 1/12. And you're telling the owner 1/12 of the interest is mine and 11/12 is yours because you're going to have this bond for 11 months and I had it for 1 month. And of course, you're multiplying this by the coupon payment. So this accrued interest is a very easy calculation for you and I at this level of college education. Amortizing and non-amortizing bond. This word amortizing is used two ways in finance in English, fortunately not in German. Amortizing in English means that you pay interest and principal of the loan in equal amounts every period. And this is basically how you and I borrow, because we have a constant wage, and if we want to buy a car, we want to make, for example, 275 euros of payment every month, and we can afford that given our wage. And this 270 euros pays a lot of interest in the beginning and a little bit of principal, and then the loan starts going down, and more of this 270 euros becomes principal payment and less interest. And with the last payment, we have either paid the loan entirely, or in Germany, for buying a house, it's common to leave some of the debt at the end. But please don't do that as financial advice, because the bank usually has you as a monopoly. Other banks won't take you, and the bank gives you a rotten deal for the rest of that borrowing. It's better to drive down the loan to zero after 10 years or 15 years if you can. Non-amortizing is what is common with most bonds. That means the company borrows, let's say, 100 million euros by issuing 1,000 euro bonds, 100,000 of them, and pays interest, let's say 10 years. And at the end of the 10 years, the company owes these bondholders 100 million. We also call that a bullet loan, because at the end, it hits us like a bullet, right? We have to pay the whole 100 million. You and I can't do that, because that sort of thing would make us bankrupt. Suddenly we have to pay, let's say, the 200,000 euro loan for the house. We amortize. But companies usually don't amortize. And it actually has a benefit, because the interest payment is a business expense, is deducted from their income statement, and they pay less taxes because of it. And this way, they keep the interest expense the same year after year for 10 years. And after 10 years, they borrow 100 million from this side of the class. They go to that side of class and borrow 100 million and pay this side off. And they continue this borrowing for another 10 years. And obviously, individuals can't do that, because when I go to the bank again to borrow for another 10 years, they say you're too old and you may die and not be able to pay this loan. And so theoretically, the companies have unlimited life. Practically, the average life that a company exists is about 50 years. But some of them die a lot younger, and some of them go a few centuries and they are with us. A sinking fund, that's a good name, you should know, gives you this sinking feeling, right? A sinking fund is something that a company that has bad credit does. They agree to a sinking fund. I just told you that companies usually don't pay interest, pay the whole principal of 100 million at the end. But if we are not so sure that this company is creditworthy, they make the deal sweeter by saying, I only pay interest for the first 5 years. But at the 5th year, I'm going to start saving money, usually in a trust account. And this money is enough to pay toward principal. And this way, if the company can't pay for principal, we would know it a lot sooner. And knowing bankruptcy and default a lot sooner prevents huge losses at the end when all the assets are burned. So sinking funds essentially says some of these bonds have to be paid off. There is another way of doing sinking funds, and that's by paying the old bondholders. So rather than putting money, saving it in a trust, the company starts calling these bonds. Let's say after 5 years, they start calling the bonds and paying half of this debt over time. Amounts to the same thing. Half of the principal is paid. But again, this call is defined as a sinking fund. We all know about it. And this sort of call usually is attached to a loan where it's riskier and we're expecting it to become discounted anyways. So this is not something that makes the bond cheaper, and actually it may make it more strong. But it happens to companies that have financial difficulty. I said there are two types of amortizing. One type is with debt. And the other type is when you talk about depreciation and amortization. Amortization is used in English to refer to a non-physical asset losing value, like for example, patent getting older and going half price, so you amortize and take some money off your income statement for this asset. Call provisions, I already talked about them here. We have them in writing with some examples. It says you have call protection for a couple of years. And the example is a 10-year, $1,000 bond that pays 5% semi-annual coupon. It can be called after 3 years. So the 3 years is the number of years that you have call protection. First 3 years, the company cannot pay you back. If they want to pay you back, even if the bond had been discounted and gone to 800, they still have to pay you 103. And 103 here means 103%. So 1,030 or something. They have to pay a premium, this 3%, plus the face value of the bond, even if it's discounted. And this goes in on a step and says if they wait 5 years, which is if this is a 10-year bond, it's half life. Excuse me. So we are sure that, okay, we made money for 5 years, and then after that we say, okay, you can pay me at par, which is 1,000. This makes the deal or this call a bit sweeter. And of course, calls always make this debt cheaper. Their price will go down or they have to pay you more interest. And some of these features there, having a premium and having a number of years to wait, would make this discount as the company has to spend less cost on it and they would get some ability to repay the loan. Refunding is easy. It's basically paying the debt. Refunding is calling or redeeming, another word for calling a bond using the proceeds of a lower cost issue. This is usually what people do, even if they are not allowed to refund. They found it, and they find an indirect way of borrowing and paying off a loan that costs more money. So when our bond is callable, we know that it would be refunded. When amortizing a security, repayment of debt more than a scheduled principal payment is called prepayment. This sounds fancy, but in a simple English word means your loan is, say, $270 a month, and this month you make a lot of money, or I don't know, your tanti gives you some money, 10,000 euros. You want to go to the bank and give them the 10,000 and reduce this loan. So you're partially paying for your loan. Or 1 month you have more than 270, you want to pay 500. The extra would go reducing your principal. So it's very helpful. And it's a financial advice. If you can do it, do prepay. But this financial advice comes with a grain of salt. Number one, many loans don't allow it. So this is like the call feature. Are we allowed to pay more than it's there? Sometime when you get mortgage loans or personal loans, they allow some limited amount. For example, your payment is 270, you can pay up to 500 extra, and then that's a very good advice to pay that if some months your finances are very good. The example here, I read it for you. It says your remaining mortgage balance means you borrowed for buying a home, is $100,000 and you're paying 12% interest on this $100,000. So your payment is $1,200 a year. Divided by 12, that would be 1,000 interest every month. But you also pay 1,200. And the 1,000 is interest charged for having the bank's money, the 200,000 rent for having this 200,000. I'm sorry, it was 100,000. And the extra 200 every month reduces your 100,000 loan. So next month, your mortgage balance is 9,800. It's gone down by 200 because you paid 200 extra more than interest. But now you want to make more payments. For example, you pay 2,400 because this month you have more money. Now that entire extra 1,200 obviously will reduce the amount of your loan. So instead of being 99,800, it goes to 98,600. And then every month thereafter, your interest becomes a smaller too because you have less debt on your shoulder. Sinking fund, I defined it, I put it in writing in these slides. It says it's a provision to use a trust fund to partially pay off a loan over its life rather than all at maturity. A firm with weakest financial position may get a better rating by committing to a sinking fund. Usually sinking funds are for bad companies. And I'm using that word bad loosely here. This is a company that has some credit issues, some more default risk. They're not AAA, they drop to AA or something. Compared to amortization on a term loan, sinking fund is not necessarily equal payments of principal and interest. We define these unequal payments and we define them essentially based on the ability of our firm to make these payments later on, making it suitable for ourselves and investors kind of know it ahead of time too, and they know that these payments are helping with signaling that the company is healthy, can make it, and they're not going to go bankrupt. It reduces the risk to investors. Less likely that the company goes bankrupt, or sooner we get warned about their bankruptcy. It shortens average maturity. Average maturity is something we calculate with duration, and roughly it says for how long the whole amount of the loan is on your shoulder. If you borrow 100,000 to buy a house for 10 years, for the entire 10-year, 100,000 loan is not on your shoulder. Day one, 100,000 loan is on your shoulder, but when you get to year 9, you have paid a lot of this 100,000 and less of it is on your shoulder. So we calculate the duration when the entire loan is on your shoulder, and that might be roughly 5 years. It's a financial concept, and that tells you for how long the entire loan is on your shoulder. Sinking funds can become negative, and that's this little sentence I have at the end. It harms investors if interest rates decline after issuance. Usually we do it for companies that have basically difficulty in payment. Usually it's a positive thing because we get them to become more creditworthy and pay this thing. But at the end, if the interest rates drops and this firm, pays off our bond, then we have to go to market and invest this money at a lower interest rate, and we can get hurt. It can backfire too in that case. How are the sinking funds executed? Very much similar to what I talked about calling a bond. Bonds might be purchased at the open market, and these are people who are willing to sell their bonds. Bonds are liquid. We want to get out of this investment, which was a loan we gave to Siemens. So if that's done that way, it's quite voluntary. These are actual sellers. But sometimes we are getting them from people who are forced to sell. And essentially, this word force means we are giving them a financial difficulty. Their bond is worth 1,200, and we want to give them 1,000 because the bond is now a premium bond. And in that case, we go through a trustee, and the trustee does it random, as I said before. So some insiders are not favored over outsiders when this financial basically loss happens. And there are regular prices and redemption prices. I gave you an example before. So these are just two names to remember. Regular price is buying the bond at the price of 1,000, which is its par price. And redemption price is if there is a premium, for example, at 1,003. That was my example. So you have a different price for redemption. Then we go to a number of theories about bonds. The most important one is the term structure of bonds. Term structure means that interest rates are coded yearly, but you only pay for the amount of time that you have someone else's money and you borrow it. So if you borrow money for a month and yearly interest rate is 12%, we still say we borrowed a month at 12%, but we divide this 12 by 12 months and we pay 1% interest on the borrowing, let's say. But then the difficulty we get into is the interest rate for 1 month borrowing coded per year is different from the interest rate for 1 year borrowing coded per year. Typically, we go to borrow for a house and the bank says, do you want to borrow for 10 years or 15 years? You say, what's the difference? The bank says, if you borrow for 10 years, I give you 4% interest per year. If you borrow for 15 years, I give you 5% interest per year. So we borrow for longer time, 15 years, and we pay more interest every year than borrowing for a shorter time. This is a normal term structure of interest rate. Borrowing for shorter period of time, you pay less interest, or as an investor, you receive less interest. And borrowing for a longer period of time, this interest goes higher. There are various reasons for it, but for common sense, we could say that if there is a long time until we get our money back, a lot of disasters can happen over a long period of time. A short period of time is more predictable and it's safer. Therefore, we make less interest, less default risk in it. But there are other considerations, and we want to discuss this with three different theories. One is expectation theory. That's the most prominent one that you would hear in CFA exams. It basically says that this yield curve, which is another word for term structure of interest rates, and maybe I should show you a curve. The curve looks like this. And maybe I should backtrack from this curve to those theories because it would make it easier for us to understand. This curve is for data for 2002, Brigham and Houston have it in their textbook, and they use this old one because it has something interesting buried in it. First of all, on the horizontal axis, they have years to maturity. For how long do we borrow? So they have a 3-month loan and we borrow for 3 months and the interest is 1.56% and that is done on the vertical axis, which has the interest rate. And the last data they have is in 2002 October, and US government borrowing, if it borrowed for 30 years, it paid you 4.65%. So you go to 30 on the horizontal axis and you go up to 4.65% and get that little blue dot and connect these dots and you have a yield curve. So yield curve basically gives you a relationship for maturities of a loan, here loan to US government, and the time that that entity borrows. And as you see on this yield curve, when you borrow for shorter time, for example, 3 months, you only pay 1.56% interest per year. But if US government borrows for a longer time, like 30 years, then they pay 4.65% interest per year. And that common sense thing is buried here. Over a long time, a lot of things can happen. But that common sense thing is explained with a lot more detail with the theories of term structure that I had in my previous slide, and I want to go over. But there is one thing about this graph that is quite interesting because it's a real world graph, and Brigham and Houston chose it because of that. And that's the fact that the 3-month interest rate is 1.56. And if the US government borrows for 6 months, it goes down. It goes to 1.53. But for every other maturity, this yield curve is upward sloping, meaning that if you borrow for a longer period, you pay more interest. But for 6 months, it went down. And that interesting point is that this is a market that is done in an auction, and it's based on demand and supply. And if fewer people show up to loan money for 6 months to US government relatively to 3 months, then these 6 months had fewer customers, and the interest rate was different. So that kind of irregular term structure is also possible. Going back to theories, essentially saying how this thing happens, the expectation theory says this yield curve, the curve you just saw, has a shape. We're really worried if this thing is upward sloping or downward sloping. And coming back to this graph, you see downward sloping too. Think of this thing as a road going up a hill. Upward sloping means if I walk on it, I get tired. I have to climb a hill. But downward sloping means it's high for short periods, and then it goes lower. So if I walk on it, it's downhill. And this downward sloping does happen sometime too. One reason that it happens is US government has high inflation, but we all expect them to tame inflation. And then after 30 years, they would pay lower interest because less inflation is in there. And that's expectation theory. This kind of thing happened, for example, in 1970s. US government had huge inflation and short-term interest rates were about 17%, but still it was considered a safe instrument. So we would have loved to loan them money for 30 years and make 17% and have a risk-free asset. So a lot of people offered loans for long term, and because of this supply and this expectation that inflation would be tamed in US, which eventually was in 1980s, the long-term interest rates were shorter or smaller than short-term interest rates. The other theory is liquidity preference or liquidity premium theory. This one basically says that this yield curve should be upward sloping, and most of the time it is. And it just basically says if you tie up your money for 30 years, it's not liquid, and you're not too happy because there might be a financial disaster and you may need your money. So short-term tying up your money is better. This kind of works, especially with a bank certificate of deposit. We go to the bank and say how much interest. They say, well, I pay you next to nothing. But if you're willing to put your 10,000 euros 1 year in a certificate of deposit with me and not touch it, if you touch it, I give you a penalty. If a whole year the money sits here, I pay you 1%. But if you let it with me for 2 years and don't touch this savings, I give you 2%. So that one becomes an upward yield curve. You get 2% per year for 2 years, but 1% per year for 1 year, tying up your money. This liquidity preference does not work with a downward sloping yield curve, doesn't explain that, and it has all kind of other theoretical holes in it. For example, when we tie our money for a short period of time, and then later on investments with that high return may not be available to us, and that may lead to a discount, and we may prefer to tie our money for a longer period of time when the interest rates are favorable. And there is this market segmentation theory. We just should know a few words about it if it comes in a CFA exam. Segmentation means just like marketing, you have different segments of customers. You have some customers who prefer to tie their money for a long period of time, and this might be people in a mature age saving for retirement and having a 10-year horizon and wanting to, put this money tied up for 10 years. And there would be another segment, just like marketing customers who do not want to tie their money for 10 years, but are more happy loaning for 1 year or shorter. Theory of interest rates is quite simple. It goes back to Fisher, and Fisher has an equation for interest rates, and that equation says on the left-hand side, Siemens should pay interest equal to, and on the right-hand side, the risk-free rate of return, what the German government pays for their bonds. But Siemens should pay more because they're not German government. They can go bankrupt easier than German government. Therefore, they have to pay a bit more, and we call that bit more default risk premium. And we also have a liquidity risk premium. If this is a small company and there is a small market for selling their bonds, then we demand a little bit higher return to make up a bit higher interest rate, to make up for the fact that once we go to sell this bond, if we need our money quickly, we have to pay a lot of transaction costs. The dealers charge more for markets that are thin when there aren't enough customers. They buy it cheaper from us and sell it more expensive to us. So Fisher says add a default risk premium, add a risk premium also for maturity. The longer the maturity, that common sense thing I said, a lot of things can go wrong. Maturity risk premium, and so on. So a number of items are added to the risk-free rate. Let me stop here. There is more lecture notes on bonds for those of you who are interested in bonds. Let me go back to the internet site and talk a little bit about questions, comments. Any questions, comments from the class here or from people on internet? I stop sharing here. And stop the recording.